Where does banking stand today, and how has it reached this point? Fourth quarter 2008. The financial crisis triggered by Lehman's collapse plunges banking into a 5-year time warp, and its survival will depend on recovering capital levels. First quarter 2014. Banking emerges from that warp. It intends to recover its usual highly profitable transactions with captive and weak customers who are mortgaged and who have little to choose from other than traditional banking. But what has happened to customers in those 5 years? A very large number of customers has chosen to use their smartphone and/or tablet. At any given time, they know where their friends are, where they're going, and even their mood. They know each professional and personal detail about their contact. They can use it anywhere and at any time, and they feel comfortable about it. Now they can take smarter buying decisions. They can easily choose one or another option by a simple click. Consumers feel that when they perform transactions through a digital channel, the balance of power is shifting, and now they have control. Consumption of financial services is not immune to this new scenario. Consumers are reaching the first level of the hierarchy of human needs in Maslow's pyramid. Self-esteem. Permanent connectivity has become a hygienic factor and a point of no return toward digital banking. What has happened to traditional banking in those 5 years? It has managed to survive, but it now faces unexpected problems. The customer's behavior has changed. Shadow banking has emerged, and new players have arrived on the scene. The image of banks has taken a severe battering, while the new players have many fans. Users have no problems in sharing their details with the new players because they feel that their data are used to their benefit. Also, they recommend these new players to their friends. Meanwhile, traditional banks are being slow to respond to this situation because of banking regulation, inflexible legacy systems which are expensive to maintain. Banks have cut back their IT budgets. Banks' unwieldy organizational structures. Banks are not used to dialoguing with customers, and the gulf between them is growing wider and wider. Faced with this situation, banks want to go back to their pre-Lehman status and stress the need for face-to-face interaction in branches. Customers steer clear of the traditional banking system and begin to look for other options. It's against this background that we see new players emerge. Banking is destined to become a utility if it doesn't take steps to redress the situation. How is the customer's behavior going to evolve in the coming years? Customer behavior is changing and will continue to change retail banking through the 4 evolutionary stages. First phase, Internet banking. Internet becomes the priority access point to the bank, and the branch becomes less important. Second phase, mass adoption of mobile devices. Through bank websites and apps, customers can meet all their banking needs except for cash transactions. Third phase, mobile wallet. This involves replacing the credit card with the cell phone and the gradual disappearance of cash and branches. If only 50% of cash transactions are replaced by electronic payments, the current model of branches and ATMs becomes economically unsustainable. Telephones are used as a channel for day-to-day banking, and the bank account becomes a commodity, which no longer requires a full banking license. And phase 4, everyone is a bank. Because cash disappears, banks lose their dominant position in retail banking. The usefulness of banking products is linked to the process of buying the product in question, in the right place, at the right time. And anyone has the opportunity of becoming a bank. For example, a business school, a travel website, or a furniture store, which directly finance their customers. If banks lose daily contact with customers at the expense of other operators such as telcos or internet giants, then they will be relegated to the position of utilities. The new value of banking is not so much being a bank, it's more a question of understanding the role its products play in the consumer's life and making these products available in the right place at the right time and in the right way. Banking has the means to change its destiny, although every day it has less and less room for maneuver. Banking is able to take a step closer to its customers by adopting the new methods already used by new players, focusing on the user experience via big data and the use of social media. Banks' current problems with their customers arise due to the poor user experience they provide in an isolated way for each one of their channels. Most customers use the website as the core channel. They use their cell phone to carry out simple actions, as it is still an emerging channel. Their tablets for queries and simple transactions from home. Call centers when they have a problem or they can't find something online. ATMs for withdrawing cash. And branches as a residual channel, when they can't do something through other channels or they need advice. Branches provide psychological support for elderly customers, but not for the rest of customers, the majority, who have less time and prefer the internet. Branches have to evolve toward a less branch philosophy, with more profitable and specialized branches, focused on advisory services and not on transactions. In the long term, only a small number of flagship-type centralized branches will remain. ATMs will continue to exist as long as physical money continues to circulate, but cash will probably be phased out at some point over the next 10 years. In the near future, ATMs will probably be integrated with cell phones until they end up fading out of the picture. However, thanks to technology, consumers are starting to use new practices to purchase or hire a service. They have access to much more information, allowing them to compare products easily, to receive customized offers while they're buying, and lastly, they quickly tell other people about their user experience. Banking needs to advise their customers at that initial stage, enrich their offering during the buying process, and help them to easily recommend their experience. As things stand today, it doesn't do any of these three things. Big data is becoming a competitive advantage in all sectors. In addition to this, storage and computing costs have also fallen significantly, turning big data into smart data as a differential element. Banks have more valuable details about their customers than any other company in any other sector. And one way to fight off these new players is monetizing this information. Banks can use their data to their advantage with two objectives. One, to improve their customer segmentation, to be more operational, or to optimize income from services. Two, to propose products from other sectors to their customers. Meanwhile, social media now have a massive presence, and customers now hope to use them to find their bank. This is an ideal opportunity to bridge the gap between the bank and the customer, because it allows the bank to have a better understanding of customer needs, to provide them with a better service and assess their risk more easily. They can be used as an additional low-cost distribution channel. They provide a higher level of security and communication, which means a better service for customers. However, banks have to overcome a number of challenges if they are to take advantage of social media. It is a very large and dynamic area, and one which is still confusing. It is essential to properly manage regulatory compliance in protecting customers' data. It is important to communicate in a sensible and coherent way, something which proves difficult with the high levels of participation to be found on these networks. The best social banking platform does not work unless there is a change of mentality about the way banks operate.